What is the role of variance in the cost volume profit analysis? Well, to start with, let's look at exactly what the cost volume profit analysis is. It generally looks to see how any variation in costs or the volume of sales affects the profits rendered from those sales. Now, generally, the CVP analysis is used primarily as an aid in budgeting. That is, you can determine what changes are going to affect operations in the future. So one, you can plan, you can report appropriately, but then again, you can allocate resources to meet the needs and expectations. Because once again, as long as operations are still feasible, as long as you have an understanding of how costs are going to vary, you can allocate them efficiently and you can dedicate or designate resources to meet those cost needs. Okay, now variance plays a very important role because the cost volume analysis is made up of so many different equations. You need to calculate your contribution margin ratio, your variable expense ratio, and your break-even point. All of these have metrics in them like revenue, variable cost, total sales, cost per unit, total fixed cost, those types of things. And those are ultimately used to carry out an analysis in the form of what if, right? A simulation analysis, meaning that if a certain aspect changes, what is the result on profits? You can actually spin that around as well and determine how any changes, for example, in fixed costs or the contribution margin ratio, how that affects your break-even analysis, what you need to break even, or you can even project with it and make determinations of how many units you would need to sell in order to meet break even or to achieve a specific target profit. So once again, all of these are moving elements as part of the analysis. Now, with any budget, you're going to allocate a specific amount of resources to a given situation. Any variance in any one of these elements is going to have an effect, right? And so much of the cost volume profit analysis seeks to measure the variance or predict the variance so that you can plan for it accordingly and how you're going to react to it. Okay, one important metric is the degree of operating leverage, and that's your contribution margin divided by net income. And that's going to tell you again how income changes relation to sales. Well, those are two of the most important variables as to what is going to be necessary moving forward to meet budgets, and it's also going to be a primary driver for reporting in terms of what you expect your operations to yield to all stakeholders involved. So that's generally the role that variance plays in the cost volume profit analysis.